If you own gold right now and all you can see is the drop, then you are staring at the least important part of the story. Price tells you that somebody is selling. It does not tell you why. And in markets, that is the difference between getting shaken out like the crowd and getting positioned like the people who understand what is actually happening. What I am looking at right now is not a normal correction. It is not some cute little technical pullback. It is not a mood swing. It is not weak hands taking profit. What we are living through is a sovereign margin call. That is the phrase I want fixed in your mind. A sovereign margin call, because that is the mechanism most people still do not understand. Countries that spent years buying gold to reduce their dependence on the dollar are now being forced to sell that same gold. Not because they changed their mind about gold, not because the long-term case vanished, but because war, oil, dollar shortages, and currency defense are cornering them into liquidation. And when you understand that, the whole picture changes. Suddenly the drop stops looking like the death of the bull market and starts looking like something else entirely. It starts looking like forced selling inside a still bullish long-term structure. That is a very different thing. I have always believed that the right question in markets is not simply what is moving. The right question is, who is being forced to act? When a man sells a wonderful business because he needs cash for a divorce, that tells me one thing. When he sells because the business itself is broken, that tells me something else. Gold is no different. If a central bank sells because it no longer values gold as a reserve asset, that matters. If a central bank sells because it needs dollars immediately to keep its currency from cracking under wartime pressure, that is a very different kind of sale. One is strategic, the other is desperate, and desperate selling has a habit of creating opportunity for people with a stronger stomach and a longer time horizon. That is the frame I want you to keep all the way through this, because the mistake ordinary investors make is they watch gold fall while the world is on fire and they conclude the thesis must be wrong. They think if the Middle East is unstable and gold is dropping, then maybe gold is not a safe haven after all. That sounds logical until you understand the mechanism. And once you understand the mechanism, it becomes obvious why gold can fall in the middle of a geopolitical crisis without the long-term reason for owning it changing at all. In fact, the crisis itself is the reason the forced selling exists. So let me walk you through it the way I think about it. For several years, central banks were buying gold hand over fist. China was buying, India was buying, Turkey was buying, Poland was buying. A whole group of countries had been accumulating metal because they wanted less exposure to a dollar system that no longer looked politically neutral. That part of the story mattered more than most people realized. When the United States and its allies froze Russian reserves in 2022, every serious policymaker in the developing world learned the same lesson at the same time. A reserve asset inside another man's system is not fully yours. A dollar balance can be frozen. A foreign bond can be sanctioned. A payment rail can be blocked. Gold is different. Gold sitting under your control does not depend on anybody else. As promised, it has no counterparty. It does not need an email from Washington to keep existing. That realization did not create a social media trend. It created a strategic shift. That strategic shift is one reason gold had such an extraordinary run. And because the run was so dramatic, a lot of people made the lazy assumption that the story was simple. They said central banks are buying, the dollar is weak, gold goes up, end of story. But good investing does not come from slogans. It comes from understanding what can interrupt a trend, what can distort a price, and what kind of selling is temporary versus permanent. That is where we are now. The Iran war did something that most people still have not thought through carefully enough. It did not merely create fear. It did not merely raise headlines. It changed the dollar needs of entire nations almost overnight. That is the part that matters. Take Turkey. Turkey imports the overwhelming majority of its energy. Oil matters enormously to Turkey. Gas matters enormously to Turkey. And those contracts are not settled in wishful thinking. They are settled in dollars. When war disrupts flows and energy prices jump, a country like Turkey does not get to philosophize about it. Its import bill goes up, its need for dollars goes up, its currency comes under pressure. And then the central bank has to decide what kind of pain it is willing to take. There are not many choices. Let the currency fall and risk inflation accelerating, political anger rising, and confidence in the system cracking. Burn through scarce dollar reserves and hope you can hold the line, or sell gold, raise dollars, and buy a little more time. That third choice is what a lot of these countries are being pushed into. And once you see that, the recent selling stops looking mysterious. It looks mechanical. Turkey liquidated roughly 58 tons in 2 weeks. Think about that for a second. That is not some elegant portfolio rebalance. That is not a polite adjustment. That is a country reaching for collateral. That is a country saying, I need dollars now, and this is what I can turn into dollars fastest. You can call it a swap if you want. You can wrap it in central bank language if that makes people feel more sophisticated. But the economic reality is simple. It is gold being turned into immediate dollar liquidity. That is a margin call. Only instead of a broker phoning a leveraged retail trader, it is war and energy prices phoning a sovereign nation. I want you to understand how violent that mechanism can be, because most people still imagine that central banks operate from some place of calm strategic control all the time. They do not. Sometimes they are strategic buyers, sometimes they are emergency sellers, and those two states can exist inside the same long-term thesis. That is what ordinary investors keep missing. They think a sale disproves the reason for the earlier purchase. It often does not. Sometimes it only proves the seller is under pressure. Now, Turkey is the cleanest confirmed example, but it is not the only piece of the puzzle to understand why this selling can spread. You have to understand one of the dullest sounding and most important topics in all of macroeconomics, a currency peg. I know most people eyes glaze over when they hear those words, but if you want to understand gold right now, you need to understand it. A peg is just a promise. It is a government or central bank saying, in effect, our currency will hold a stable relationship to the dollar, and we will use our reserves to defend that promise. That promise works beautifully when dollars are coming in. It works much less beautifully when dollars stop coming in and start rushing out. Here is the way I think about it. Imagine a bathtub full of dollars. Normally, the faucet is on. If you are an oil exporter, dollars come in through energy sales. The tub stays full. Some dollars leave to pay for imports and business activity, but the incoming flow keeps the level comfortable. That is how the peg feels stable. Now imagine a war disrupts the flow. The faucet weakens at the same time. More dollars start leaving. Food imports still have to be paid for. Machinery still has to be paid for. Defense costs go up. Capital tries to leave. Expats move money. Investors hedge. People get nervous. Now the drain is opening wider while the faucet is slowing down. That is when the peg becomes expensive. And when the peg becomes expensive, a central bank needs more dollars than it expected. Where does it get them? Same three choices. Break the peg, burn reserves, sell gold. That is why I keep coming back to this margin call framework. It is not rhetoric. It is arithmetic. If your promise to defend the currency requires dollars and your normal dollar inflows are disrupted, then something else has to be sold or pledged to get those dollars. In a region where a lot of countries have currencies tied directly or indirectly to the dollar, and where war-related stress is rising, that mechanism matters a great deal. Now, do we have complete official confirmation for every rumored seller in the Gulf? Number and honest analysis requires saying that clearly rumor is not proof, but you do not need every rumor to be true for the mechanism to matter. The mechanism itself is real. The stress itself is real. And when you see unusual flows in London, unusual reserve behavior, and a region dealing with disrupted oil traffic, you do not have to be reckless to conclude that pressure is building in exactly the places where gold would logically become a source of emergency liquidity. That is enough to take seriously. There is another source of pressure people are not thinking about carefully enough: Russia. Russia is one of the largest gold producers in the world. And Russia is doing two things at the same time that matter enormously for price behavior in the near term and the long term in the near term. Restrictions around exports create a strong incentive for some holders to liquidate before the window closes. if you own large bars and you know your ability to move that asset internationally is about to become more constrained, there is every reason to make a decision before the door narrows. That can add supply now. But in the long term, restricting exports and building alternative settlement channels does something very different. It removes future flexibility from the traditional market and supports the development of a parallel system outside the existing Western architecture. That is why you must separate time horizons in the near term. Russia can add selling pressure. In the longer term, Russia is part of the same broader story that made gold strategically important in the first place. A lot of investors get hurt because they mix those two time frames together. They hear a near-term bearish fact and assume it destroys a long-term bullish structure. Or they hear a long-term bullish fact and assume price cannot fall in the next 3 months. Markets are not that polite. A wonderful asset can go down a great deal if the wrong holder is forced to sell it at the wrong time. And that is exactly the kind of thing I believe we are watching. If you stand back and organize the whole situation, you can see 3 distinct forces pressing on gold at the same time. The first force is what I would call the energy importer squeeze. Countries that need imported energy and pay for it in dollars are under pressure when oil jumps and disruption spreads. If dollar needs rise quickly enough, gold becomes collateral. The second force is the dollar peg defense problem. Countries that anchor themselves to the dollar need reserves to keep that promise believable. If dollar inflows weaken while outflows accelerate, pressure builds and gold can be monetized to refill the tub. The third force is war funding and pre-deadline liquidation. Countries directly financing conflict or private holders rushing to act before a legal or logistical window narrows can dump more metal into the market than the crowd expects. Now put all 3 together and the recent weakness stops looking random. It begins to look like layered forced selling that matters, because forced selling is finite. Strategic selling can last a very long time. Forced selling usually lasts only as long as the pressure does. That distinction is where the opportunity lives. I have seen this pattern in different forms over the years, not always in gold, sometimes in equities, sometimes in debt markets, sometimes in businesses. The pattern is always the same. Something good gets sold because the owner cannot afford to keep holding it, not because the asset lost its fundamental value. The public watches the price fall and concludes the asset itself has changed. The patient buyer watches the pressure and asks how long the seller can keep going. That is the better question. How long can the seller keep going? Turkey does not have infinite gold. Pressure can be large. It cannot be endless. The Gulf does not have infinite political tolerance for reserve drain. Russia's pre-deadline selling window is not infinite. China's pause is not the same thing as ideological surrender. India becoming a seller under pressure is not the same thing as abandoning the strategic role of gold. This is why I do not view the present weakness as a clean referendum on the long-term case for gold. I view it as a stress event inside that case. And once you think that way, the next question becomes obvious. If this is not the end of the bull market, what exactly is it? My answer is simple. It is a reset, and not a gentle one. A reset is what happens when a long-term bullish structure gets interrupted by urgent liquidation, weak hands infer the story is over, and price falls far enough to wash out optimism before the deeper structural buyers come back. That is the process. The word most people want to use is collapse. I do not think that is the right word. Collapse suggests the logic is dead. Reset means the logic survives, but price has to clear forced supply first. Those are very different conclusions, and they lead to very different behavior. I believe what we are going through is the second one. The logic for holding gold over the long term has not been repaired away. The United States still has a debt problem. Deficits still matter. The temptation to suppress rates and print later, rather than accept pain, now has not disappeared. The reserve freezing lesson from 2022 has not been forgotten by the rest of the world. Paper currencies have not suddenly become morally disciplined. Governments have not suddenly become less dependent on monetary flexibility. None of that changed because Turkey had to turn metal into dollars for a few brutal weeks. If anything, the crisis is reminding the rest of the world why countries wanted gold in the first place. It is reminding them that the monetary system still runs on a hierarchy, that dollar shortages can appear violently, and that the safest reserve asset inside a political conflict is often the one that exists outside another country's liability structure. That is still true. And because that remains true, I think the long-term story for gold is intact. What is not intact is the price path. The path got interrupted by stress. That is what creates the opening. Now let me give you the practical framework I would use from here, I think in phases. Not because it sounds elegant, but because it forces clarity. Phase 1 is forced liquidation. That is where we are living now. This is the stage where price behaves badly enough to make intelligent people question themselves. The headlines get noisy, the crowd gets confused. People say, how can gold be down if the world is this unstable? The answer is simple. Because the unstable world is creating dollar demands and reserve pressures that force holders to sell gold. That is phase 1. The key feature of phase 1 is that the selling is real and painful, but it is not ideological. The sellers are not saying, we no longer believe in gold. They are saying, we need dollars now. Those are not the same sentence. Phase 2 is stabilization. This is the stage most investors will not recognize until it is already underway. It begins when the pressure that created the forced selling starts to ease. Oil stops racing upward. Traffic normalizes enough that emergency dollar demand moderates. Currency pressure stops worsening. The lira stops making fresh, humiliating lows every week. The peg defenders stop bleeding as fast. The forced swaps and liquidations slow down. This does not require peace to break out across the whole world. It only requires enough normalization that the emergency need for dollars begins to cool. That is when the gold market stops trading like collateral and starts trading more like a reserve asset. Again, phase 3 is structural re-entry. This is when the strategic buyers come back into a market that has already been cleaned out, not all at once, not with a trumpet, but steadily, deliberately. The same countries that wanted less exposure to the dollar system before the war-driven liquidation will still have those motives after the liquidation ends. The same reserve managers who learned the lesson of sanctions and frozen assets will still know what they know. The same long-term distrust of pure paper promises will still exist, and they will be buying into a market where price has already been reset by forced sellers. That is where the larger opportunity comes from. The best opportunities rarely feel comfortable. They usually feel messy. The crowd usually needs a cleaner story than reality provides. But markets do not wait for emotional comfort. They reprice when pressure changes. So what do I watch to tell me phase 1 is giving way to phase 2? I watch the currencies of the forced sellers. A country under currency stress behaves one way when pressure is intensifying, and another way when pressure is stabilizing. If the lira keeps setting ugly new records, that tells you the central bank remains trapped. If that pressure starts to plateau, the urgency to sell reserves begins to diminish. That matters. I watch oil. I do not watch it because I enjoy commodity forecasting. I watch it because oil is feeding the entire mechanism. If oil remains elevated enough to intensify import stress and reserve drain, the forced selling can continue longer than the crowd expects. If oil begins to come back down and routes normalize enough to reduce the emergency, then one of the biggest legs of the selling thesis starts to weaken. I watch the Russia deadline and what follows it. Deadlines concentrate behavior. They pull future supply into the present. Once that window closes, an important source of near-term pressure can vanish abruptly. I watch official buying behavior when the smoke starts to thin. A pause is not a permanent retreat. A forced sale is not a conversion. If I start seeing the quiet institutional bid return after the reset has wrung out the urgent sellers, that tells me the deeper thesis is reasserting itself. Now I want to address the emotional error that hurts most gold investors in periods like this. They want the asset to validate them every day. That is not how any serious asset works. If you own gold because you think it is a hedge against policy recklessness, fiscal disorder, reserve weaponization, and paper currency erosion, then you must also be intelligent enough to tolerate periods where it is sold for reasons that have nothing to do with disproving that thesis. that is part of the price you pay for being early instead of obvious. A man who buys insurance and then complains when the weather is sunny has not understood the point of insurance. A man who buys gold because he believes the monetary structure is getting less stable and then panics because forced sovereign selling knocks the price down for a while has not understood what he owns. I am not saying the path will be easy. I am not saying price cannot go lower. I am not pretending timing is simple. I am saying something narrower and more useful. The present decline can be explained by a mechanism that is consistent with a still bullish long-term structure that matters because it changes how you interpret weakness. Weakness caused by the death of the thesis should be treated one way. Weakness caused by forced liquidation should be treated another. That is why I keep saying this is a reset. And I think it may be the largest reset of this cycle because the sellers involved are not retail traders and momentum funds. They are central banks, reserve managers, war-stressed sovereigns, and holders acting ahead of legal and geopolitical constraints. That is real supply. That is why the drop feels so violent. The public always underestimates how much price damage a forced institutional seller can do in a short period of time. The public also underestimates how quickly that same damage can become the launchpad for the next leg once the pressure exhausts itself. That is the other half of the pattern. Forced sellers create the floor. They do not choose the final destination. They create the condition for the next buyer. So what would I do with that understanding? First, I would stop asking childish questions like, why is gold not acting the way my emotions think it should? I would ask adult questions: who is selling? Why are they selling? How much can they still sell? What has to change for that pressure to ease? That is a much better line of inquiry. Second, I would stop treating every drop as a referendum on the whole idea. A good thesis should be stress tested. This is the stress test. This is where you find out whether you own the asset because you understand the mechanism or because you were enjoying the applause while it went up. Third, I would respect time horizon if you need price validation. Next Tuesday, you should not be in a trade driven by sovereign reserve behavior, war financing, oil routes, and global monetary distrust. Those are structural forces. They can move fast at the wrong times and slowly at the right ones. If your horizon is longer, the current phase can look very different. Fourth, I would watch for exhaustion, not perfection. Markets do not ring a bell at the bottom. They stop getting worse for the same reasons they were getting worse before. That is enough. When the currency pressure eases, when the emergency dollar demand cools, when the deadline-related selling clears, when the strategic buyers begin returning quietly. That is the shift. I do not need a newspaper to bless it for me. I need the mechanism to turn. And finally, I would remember the central lesson: gold is being sold right now by countries that wanted it badly enough to spend years accumulating it. That sentence alone should tell you how unusual this moment is if long-term believers are becoming temporary sellers because survival demands it. Then the price action is telling you more about the pressure on the seller than it is about the permanent value of the asset. That is not a reason to be reckless. It is a reason to think clearly. The crowd always wants clean narratives. Either gold is going to the moon or gold is a bubble. Either the bull market is perfect or it is dead. Real markets are more complicated than that. Sometimes the truth is that the long-term argument is still alive while the short-term holder is being forced to dump collateral into the market. That is the truth I see here. And if I am right, then this period will not be remembered as the moment gold failed. It will be remembered as the moment gold got thrown overboard by the people who needed dollars more than they needed conviction. That is a brutal thing to watch if you are unprepared. It can also be one of the best setups of the cycle if you understand what you are looking at. So here is the final test I would leave you with the next time you see gold falling in the middle of a geopolitical crisis. Do not ask whether the market has gone insane. Ask whether somebody stronger than a retail trader has just been forced to sell. If the answer is yes, then do not confuse liquidation with invalidation. Those are not the same thing. And if you cannot tell the difference, then this market will take your mettle from you before the real move even begins.